Hello, fellow Rebel Capitals. Hope you're well. So we had a bankruptcy report come out today, and I think this highlights what's really going on with the U.S. economy. Once you kind of break through the narrative, you scratch beneath the surface, this starts to make sense when you connect the dots with this report and what people are actually experiencing. I think it's fantastic to look at this report through the lens of what's happening with geopolitics and how that's having a big impact on small businesses. So let's go over to this report. It's not from Zero Hedge, but they've got a good article on it. So I want to do the screen share. We got that going. And here we go. U.S. bankruptcy filings surge 7% year over year in May. So this is for businesses and individuals. And let's scroll down here. They actually kind of get into the nitty gritty where they look at chapter 7s versus chapter 11s. And the chapter 11, I don't have any data on this, but that would lead me to believe that those are kind of like bigger businesses. But let's get into the nitty gritty here. The May data reflects a continued but measured uptick in bankruptcy activity, particularly among small businesses. So when you're looking at how the economy is really doing, can you really look at OpenAI? Can you really use NVIDIA as a proxy? I don't think so. I mean, maybe that's a proxy where the S&P is going, but you guys know that the stock market is completely and totally removed from the real economy. So I think if we're looking for a proxy as to what's happening with the real economy, it's much better to look at what's happening with small businesses. And we can see that the bankruptcies there are skyrocketing with the small businesses and individuals. So let's keep going here. The trend highlights the cumulative impact of elevated interest rates, persistent inflation, and higher operating costs as access to affordable credit. Now, look, so notice they said access to affordable credit, and they're talking about interest rates. But you guys know that if we look at a chart of interest rates going back 40, 50, 60, 70 years, to say that interest rates are sky high right now, I mean, come on. They ain't that high. I mean, the Fed funds at what, 3.6? I mean, it's not that high. But the key here is affordable. So it's not that the interest rates are too high or that credit is unattainable due to the interest rate. It's that it's unattainable due to the fact that they can't afford it. In other words, they don't have the cash flow to cover the debt, which is an aggregate demand problem. It isn't necessarily, or it could be a balance sheet problem as well, that's a result of aggregate demand. It isn't necessarily the fact that, oh, it's because interest rates are high. That's what they always try to make it seem with these articles in the mainstream media, is that they make it seem like the Fed funds rate is like 15%, and therefore access to credit is totally unaffordable. That's a misrepresentation of the truth, in my view. So more businesses and consumers are turning to restructuring tools to stabilize and reset. They're not resetting financially. They're just trying to kick the can down the road. They're just hoping that, okay, if I restructure or if I just find some way to borrow additional money just to pay off the money that I owe right now, that magically the economy is going to improve in the next 6 months. Now, here's one of the keys. The 12-month inflation rate has consistently remained above 2%. Okay, well, we all know that it's much higher than that. In February, inflation rate was 2.4%, which surged to 3.3. Now, 3.8. Why did it do that? Well, right here, these higher fuel costs, energy costs, and food. So if you're looking at a small business, that energy cost is going to impact them. It's going to impact their inputs. Right. And this goes back to what I say on this channel all the time, where most people think that if oil goes to 120 or 140 or 200 or whatever, that just means that we're going straight into the 1970s. And that's not true. Now, temporarily, that's going to increase the CPI. Absolutely, it is. It's going to increase mostly food and energy prices. But at a certain point, that hits aggregate demand. And that means that demand is lower And that means that businesses go bust because demand is lower, their inputs are higher. And at a certain point, they can't raise prices because it destroys demand so much that it forces them into the inevitable, which is bankruptcy. And these small businesses employ people. As you guys know, small and mid-sized businesses, they're the main engine of job growth in the United States. So if these guys are going bust, then they got to fire people. Well, that just reduces aggregate demand further, and you get into that death spiral. So that's why it's really important to, and that's why I wanted to focus on this story, not just because it's, I think, very relevant to what's happening with the underlying economy and the real economy, but also it sheds a light on why, when you get higher input prices due to energy that's happening because of obviously geopolitics and the Straits of Hormuz, that often leads to disinflation, if not deflation, although it starts off with an inflationary burst, let's say. They talk about how the Fed's fund rate is elevated. It's not elevated. 3.5%? I mean, come on. Elevated compared to what? Zero? I guess you could say that. It's elevated compared to where we have been since 2010, 2011. Here they get into the chapter 11. So in the May 14th report, S&P Global warned the trajectory of bankruptcy filings could increase over the coming months, citing inflationary pressures. How would they not increase? Like, what would be your argument for them not increasing? Because if you assume the reason they're increasing is because their input costs are going up and they can't increase their prices because the demand is just not there. The economy is too soft. And therefore, if your input costs are here and your prices are here, okay, you're good. But see, what's happening is their input prices are going up here and they can't raise prices, because if they raise prices at all, then their revenue plummets and then you really get an imbalance. So it just gradually kind of goes like this until the point where they've got to wave the white flag and like, we can't do it anymore. We've kicked the can down the road as long as we possibly can, and it just doesn't work with our revenues being here and our inputs being here. Then they file bankruptcy. That increases the unemployment rate, or that, all is being equal, that would increase the number of unemployed people, which lowers aggregate demand. They ain't getting a paycheck anymore. And also, if they're not getting a paycheck, they're looking for another job, they're going to really tighten their belt. They say half of all small businesses. I like how they put 50%. You don't say. Thanks for the help on that one. My goodness gracious. Who is the average zero hedge reader here? Half of all small businesses. By the way, that's 50%. Thanks for the tip there. Have increased prices to protect margins, while the others have turned to low-cost vendors. Right, but the low-cost vendors, what are they doing? They're doing the exact same thing. They're trying to lower their costs, but their inputs are going up. They're trying to just take it on the chin, right, to try to survive the next 6 months, but then they go bust. And then the low-cost providers aren't there. And in half, they say they're increase their prices to protect margins, but it doesn't say what that has done to demand and whether or not those increased prices are sustainable. So they talk about how you had a blowout jobs number, which you did, but 172, although the expectations were for 80, it's still a bad number. It's still not good. However, the number of Americans filing for unemployment benefits, a 4-month high. That's talk about initial claims, I believe. And by the way, with the JOLTS numbers that we saw, that was blowout. But remember that the quits and the hires were extremely, extremely low. So sure, you might have all these job openings, but the employers aren't hiring anybody. And then the workers really know what's up because they ain't quitting. And what does that tell you about the health or the strength of the labor market? If people aren't quitting, that means they're afraid to quit because they can't get an equal job or maybe even a better job. So you've got all of this data that's really converging, and a lot of the data is, let's just say, conflicting. SBA announced small manufacturers will be eligible to secure loans with 90% federal guarantee. Right. So this is just, let's have the government bail everybody out. That's what they're saying there. So let's go over to what's actually happening with real interest rates. And by the way, was just at Rebel Capitalist Live, as most of you guys know, and I was up on stage with Kenny McElroy. And most of you guys know Kenny. He's like one of the top multifamily guys in the United States. I think now he's managing, was it 3 billion in assets in multifamily properties? And I asked him, what is the most important interest rate for the real estate guys like Kenny McElroy? And he says, definitely the 10-year treasury. And I thought that was important because when even the real estate guys like Kenny, whenever they talk about interest rates, they're always talking about the Fed, 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 the Fed. At the end of the day, does the Fed matter? I mean, to the 10-year? Yeah, I mean, maybe a little bit here and there, just because let's just say they hike rates. Let's just take it to an extreme. Let's say you've got the Fed funds at 3.5 and you've got the 10-year trading at 4.5. Let's just assume for a moment that the Fed took rates, the front end, up to 10%. Okay, well, what is that going to do? Now everyone's going to go, why am I holding a 10-year when I could just hold a 3-month treasury at 9.8% or whatever? So you are going to get that demand suck from that's a funny way to say it, isn't it? From the 10-year treasury, demand goes down, interest rates go up. But only to a certain point where the banks are going to step in. They're going to be that marginal buyer and seller, like we always talk about on this channel. But that's taking it to an extreme. Like, how much demand suck are you going to get from the 10-year treasury if the Fed hikes rates by 25 basis points or lowers by 25? I mean, not that much. Now, that's not to say that the front end is exactly where it should be based on where the market would put the overnight rate. I think it most likely would be quite a bit lower. But my point here is that what the Fed's doing over the next 6 months, it doesn't really impact the interest rates that are really, really, really important in the real economy, such as mortgages and even the guys that are building the real estate, like Kenny, these multifamily projects, where what they're paying is directly tied to the 10-year treasury. So the point there is when you're looking at the businesses that are filing bankruptcy, when you're looking at private credit, most people think that private credit's a nothing burger because it's just these software companies. Whoa, 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 whoa. Time out here. Time out. In fact, this goes back to Kenny because Kenny was talking about how he's buying all these properties for like 40 cents on the dollar because all these guys that got way over their skis. He said, in fact, the bloodbath is what he calls it in the multifamily space, says nobody's talking about it, but he says it's just as bad as what he saw during 2008, 2009. He said just as bad. And it's just the fact that it's multifamily instead of single family. So the mainstream media is kind of sweeping it under the rug as though it doesn't exist. But he's like, this is a really, really big deal. And I said, okay, well, whose balance sheet is it impacting? And he said, a lot of the pension funds. And also, he said, a lot of private credit. So when you sit there and think about the Blackstones or the BlackRocks or the Blue Owls, or, you look at that and you're like, oh, well, it's all about software and, that's going to rebound. No problem. But we forget it's not just about software. There's a lot of toxic sludge on those balance sheets in the form of, how about subprime auto? Did we forget about Tricolor already? And then according to Kenny, they've got a lot of this garbage that nobody knows about on their balance sheet in the form of loans to these multifamily guys that got over their skis and are now blowing up. Got over their skis in 2022 and 2023, and now all the chickens are coming home to roost. So I think we should really focus on these bankruptcies. I think it's a big story that we've got to pay attention to because it's really telling you what's happening with the underlying economy. And if the Straits of Hormuz continue to be closed and we have these, let's say, even if it is transitory with the inflation, with the input costs from food and energy, we should expect the bankruptcies to continue as far as the individuals and the small businesses, and all else being equal, you would assume that at a certain point that would impact demand in the real economy. And then from the producer side, you look at the 10-year treasury and, is it high historically? No, but it's probably not going anywhere. It's probably not going to 2%, let's say, within the next 6 months. And by the way, if it does go to 2%, that's an even bigger problem because that tells you the economy is collapsing. All right, guys, enjoy the rest of your afternoon as always. Make sure you're standing up for freedom, liberty, free market capitalism. We'll see you in the next video.